this point in time, given the strong volatility that we are seeing in the market, what should be your strategy and how should you position yourself? Let's try and find an answer to that. And for that, we have been joined by Unmesh Sharma, Head of Institutional Equities at HDFC Securities. Hi, Unmesh. A very good afternoon and thank you so much for your time. First up, Unmesh, help us with your take on the markets reading, because wanted to understand that how should one play the markets right now, because are there some pockets or areas that still highlight that given the correction we are at levels where we should go in and buy some of these counters, or still markets are fighting some walls of worry, maybe related to slower GDP growth, slower earnings growth, the FII selling? How are you reading the markets right now?
Yeah, no, thanks for having me on your show. I think what's happened is the market's actually gone to two complete extremes. At the absolute top end, you have the large caps, which are impacted a lot more by the FPI selling, which I believe is creating some kind of, in fact, opportunity to invest. And at the bottom end, what's happening is that we believe that 2025 will be a year of consolidation. My observation has been that a lot of investors, individual investors, ultra HNIs, and even some of the schemes in the small and mid cap have a large number of positions held right now. What has happened is that because there was such a unilateral kind of buying in everything, and you could buy any stock and kind of make money in the last year or two, in the small and mid cap space, we believe that this year, however, what will happen is that the rubber will hit the road as far as earnings is concerned. So we believe that even if the market remains a bit tepid at the bottom end, just because of the fact that people will reduce the number of positions that they have through the year, it will actually lead to outsized situations. So what I'm saying is that the volatility may not continue, because may not last at this current level, but this is not going to be a year where you can expect that the index as well as the entire market as a whole as an aggregate is going to give you more than single digit kind of return. The way to play this is that the FPI selling at the top end is giving us opportunities in the large financials, in the large consumer discretionary, healthcare, and IT names. And at the absolute bottom end, we continue to believe that in the mid cap and small cap, people will continue to make outsized returns from companies which will deliver earnings, and it will become a more and more concentrated market at the bottom end as well.
Right. Hi, this is Ankita also joining in. A good afternoon to you. You mentioned that this is going to be a year of consolidation, and there could be an opportunity in the large cap space given the kind of selling that FPI is. We are seeing from FPIs. Probably it could be a buying opportunity into those large cap names. But as I can see, you have a very positive outlook on the BFSI sector. On you're overweight on a couple of banking names like Axis, Federal Bank, Canfin Homes. Tell us what according to you has changed for banking since the last quarter. I mean, what is the kind of growth that you're expecting in this quarter? Is it going to remain muted because the pre-quarter updates that have been nothing to write home about?
Yeah, so look, the strategy is coming from a 12-month perspective, and at the same point in time, we are seeing a headwind. So there is a slowdown in growth, as you know. At the same point in time, I think what is also happening is that you have to see it in the context of the valuations. So to put it into context, if you look at Nifty 50, it's trading at 20 times FY26 on a PE basis. But if you remove the financials, it's actually at 25 times. So the valuation differential between the banks as well as the rest of the market has become quite large. So what happens is that despite the fact that there is going to be a little bit of slowdown on the growth side, at the same point in time, the availability of liquidity in the last 2 quarters, I believe, has improved a lot. And what will start to happen is that as we start to see the slowdown kind of percolate through the system, we believe that banks which have, or banks, or for that matter, the financials which have better access to more granular capital, as well as where we believe that there is going to be no asset cycle kind of hits. And so, and given the fact that valuations are good, even in a slightly slowing environment for the next couple of quarters, we believe that this is the place to be.
All right, but Unmesh, also help us with your take on the industrials in the infra pack as well, because budget is just around, and what we have seen in the past 5 years, the government has been focusing on building infrastructure. I believe that you are also of the same view that this sector is expected to do well, but help us on more understanding on that. That how should one play the industrial and the infra bet, because a lot of these stocks have already been showing strength. So at given
Yeah.
a point and given such a huge basket, how should one actually go deep as well as try to focus on select names?
Okay, so look, two things have happened. From the government side, what had happened was that one was that given the fact that this time the government came in not with a single party majority, there was a view in the market that the focus of the government is going to shift to a lot more on the, bottom end of the consumption pyramid as compared to capex. At the same point in time, what happened is because of the election-led slowdown, only 42% of the total capex spent for the year was spent. So, in that context, a lot of the industrials names, capex names like, road manufacturers, etc., road builders started to look expensive. Having said that, we believe two things have happened. I think the pendulum has swung too far if you look at it from an FY26 perspective. So what will happen is that one, we believe that in the budget, there is going to be a reiteration. Sorry, three things, right? One is that in the second half, there is going to be a pickup in spend from the government because that slowdown effect is going to be countered. We may not end the year with achieving 100% target, but it will still be better than the first half. So that will be the first trigger. The second is that in the budget, there is going to be, we believe there is going to be reiterated focus on the capex, even as there'll be a little bit of talk about what happens on the bottom end consumption. But at the same point in time, the focus on capex comes back. And as we start moving towards June, what will start to happen is that a lot of these stocks will start to look less expensive because earnings would have got rolled over, and then this year would have got established, and some of the numbers would have got upgraded. So from that perspective, yeah, you may think that some of these are a little expensive, but this may be the time to start building positions in the industrials names, or what I would call the domestic economy facing names, which include things like cement and related things.
Unmesh, also talk to us about the chemical space that has been underperforming. Are you becoming incrementally positive now? I mean, just yesterday we had that news of the refrigerants prices seeing an uptick. The inventories have also bottoming out. Are you becoming incrementally positive on the chemical pack as well?
Yeah, yes. Now, of course, from a context of Nifty, I think the weight is very low. So also in our model portfolio. But at the same point in time, what's interestingly happening is that across the board, I think the chemical sector has consolidated and suffered quite a bit for the last 6 quarters. Now, this I'm talking about prior to this one. And to a large extent, that is because of the problems being in China, dumping, price corrections, capacity additions which had been done in the past coming on stream. But at the same point in time, chemicals is a little bit like early stage pharma in India, where what is happening is one is that the pricing pressures, anecdotally, we are hearing have started to come off. The second is that, the competition from China in a lot of places because of the China plus one strategy, the volume uptick from that is starting to show because, for any large industrial buyer in, let's say, Europe, it takes about a couple of quarters for them to come examine the plant and then give you the order, and then the production starts and the capex happens. So there is a cycle to it. It feels like that cycle is starting to kick off as we speak. So what may happen is that we may start to hear, maybe the numbers will not show this in the third quarter results, but what will happen is that the commentary from next week onwards, as the companies start to report earnings, should start to improve. And I believe that what will start happening is that on the specialty pharma and on the specialty chemicals, as well as some of the chemicals names where there is some pricing power because they have moved up the value chain in this interim, we believe that there could be an uptick seen from here. So we are quite constructive on the space. Yes.
Constructive on the chemical space, but Unmesh, before we wrap it up, quickly wanted your take on the IT pack as well, because today it's been the clear winner in today's trading session, and all thanks to TCS and the commentary there. But given the kind of run up, any pocket that is still looking attractive to you, or will you just like stay away from buying afresh within the IT space?
No, we like the larger companies better. Again, just like the banks, what's happened is that because the FPIs were earning that more, so technically they've come off a little bit more. Also, it feels like, even our analysts tend to prefer names where they are working across the entire chain, and giving a full stack kind of approach. Which is why you can see that in our model portfolio as well, we are still constructive. Also, there is this small tactical tailwind which may come in from the currency. So while that these are not things which sustain over 4 quarters, but at the same point in time, in an environment where we are generally seeing a little bit of consolidation in the market, there is a little bit of risk off, and these are export sectors with a currency which is generally on a slightly weakening path. I think, and less risk on the large caps. We believe that selective mid caps, but more large caps, we are quite constructive.
All right, Unmesh, with this, we'll let you go on that. Great chatting with you, and thank you so much for taking the time out and speaking with us.
Thanks for having me.
All right.
If you like this video, then like, share and subscribe to ET Now.